Futures and options are both financial derivatives that allow traders to speculate or hedge against the future price movements of underlying assets, such as stocks, commodities, or currencies. Futures contracts are agreements between two parties to buy or sell an underlying asset at a predetermined price and date in the future. The buyer of a futures contract is obligated to buy the asset at the agreed-upon price, and the seller is obligated to sell the asset. Futures contracts are traded on exchanges and standardized in terms of quantity, quality, expiration date, and settlement terms. Futures contracts can be used for both speculation and hedging purposes. Options, on the other hand, give the holder the right, but not the obligation, to buy or sell an underlying asset at a specific price, known as the strike price, on or before a specified date. Options can be bought and sold on exchanges or over-the-counter (OTC) markets. There are two main types of options: calls and puts. A call option gives the holder the right to buy the underlying asset at the strike price, while a put option gives the holder the right to sell the underlying asset at the strike price. Options can also be used for speculation or hedging, as well as for a range of other trading strategies such as covered calls, straddles, and spreads. Futures contracts are agreements to buy or sell a specific quantity of an underlying asset, such as commodities, stocks, or currencies, at a specific price on a specific date in the future. Futures contracts are standardized and traded on exchanges, such as the Chicago Mercantile Exchange, CME, or the Intercontinental Exchange, ICE, and can be used for both speculative and hedging purposes. To use futures contracts, a trader would need to open a futures trading account with a brokerage firm that provides access to the exchanges. The trader would then need to decide on the underlying asset they want to trade, select a futures contract that corresponds to that asset, and then enter into a buy or sell position on that contract. Futures contracts can be used in several ways. First, speculation. Futures contracts can be used to speculate on the future direction of an underlying asset. For example, a trader who believes that the price of gold will rise in the future may buy a gold futures contract to profit from the increase in price. Second, hedging. Futures contracts can be used to hedge against potential losses. For example, a farmer may sell a futures contract for the crop they will harvest in the future to lock in a price and protect against potential losses if the price of the crop falls. Third, arbitrage. Futures contracts can be used to take advantage of price discrepancies between different markets. For example, if the price of gold is higher on one exchange than on another, a trader could buy a futures contract on the lower-priced exchange and sell it on the higher-priced exchange for a profit. When trading futures contracts, there are several things to watch out for. First, leverage. Futures contracts are highly leveraged instruments, which means that a small amount of capital can control a much larger position. While this can amplify profits, it can also amplify losses, so traders should be careful when using leverage. Second, volatility. Futures contracts can be highly volatile, especially for commodities like oil or natural gas. Traders should be prepared for large price swings and have a risk management strategy in place to protect against losses. Third, margin calls. Traders who use leverage to trade futures contracts will need to maintain a certain level of margin in their account to cover potential losses. If the account falls below the required margin level, the trader may receive a margin call, which requires them to add more funds to their account or close out their position. Fourth, contract expiration. Futures contracts have an expiration date, and traders who hold a position on a contract that is about to expire may need to roll their position over to a new contract if they want to maintain their exposure to the underlying asset. Options are financial derivatives that give the holder the right, but not the obligation, to buy or sell an underlying asset, such as stocks, commodities, or currencies, at a specific price, known as the strike price, on or before a specific date. Options are traded on exchanges, such as the Chicago Board Options Exchange, CBOE, or the NYSE American Options, and can be used for a variety of trading strategies. To use options, a trader would need to open an options trading account with a brokerage firm that provides access to the exchanges. The trader would then need to decide on the underlying asset they want to trade, select an options contract that corresponds to that asset, and then enter into a buy or sell position on that contract. Options can be used in several ways. First, speculation. Options can be used to speculate on the future direction of an underlying asset. For example, a trader who believes that the price of a stock will rise in the future may buy a call option to profit from the increase in price. Second, hedging. Options can be used to hedge against potential losses. For example, a stock investor may buy a put option on their stock holdings to protect against a potential downturn in the stock market. Third, income generation. Options can be used to generate income through writing, selling options. For example, a trader may sell a call option on a stock they own to generate income, while limiting their potential profit if the stock price rises. When trading options, there are several things to watch out for. First, volatility. Options can be highly sensitive to changes in volatility, especially for options with a shorter expiration date. Traders should be aware of the potential impact of changes in volatility on their options positions. Second, time decay. Options contracts have a finite lifespan, and the value of the option decreases as it gets closer to its expiration date. Traders should be aware of the impact of time decay on their options positions. Third, liquidity. Some options contracts may be less liquid than others, meaning that there may be fewer buyers and sellers in the market. Traders should be aware of the liquidity of the options contracts they are trading and the potential impact on their ability to enter or exit a position. Fourth, assignment risk. If an options contract is in the money, i.e., the price of the underlying asset is above the strike price for a call option or below the strike price for a put option, at expiration, the holder of the option may be assigned to buy or sell the underlying asset. Traders should be aware of the potential for assignment and have a plan in place to manage the resulting position. In conclusion, futures and options in the stock market can be a great way to hedge against market risk and diversify a portfolio. It is important to understand the basics of futures and options trading before taking the plunge into the stock market. With the right guidance and research, futures and options can be a powerful tool for investors. Understanding how to identify potential opportunities and manage risk can be the difference between success and failure in the stock market. What strategies will you use to take advantage of futures and options in the stock market? Thanks for watching. And don't forget to subscribe.